Your credit card statement last month, whatever the minimum payment was, that number was engineered, not by accident, not by oversight, by design. The average American household carries $11,500 in credit card debt at an average interest rate of 23%, making the minimum payment that debt takes 22 years to clear. It costs $18,500 in interest along the way. That is not finance. That is a meter running on your life. And the meter was installed in 1986. Before that year, you could deduct credit card interest from your federal taxes. Auto loan interest, personal loan interest, all of it deductible. Then the Tax Reform Act of 1986 passed, signed by Reagan, and the deduction disappeared. The mortgage interest deduction stayed. The loans the banks made the most money on for the longest term, those got protected. Everything else, gone. The Treasury said the goal was to discourage spending. The result was the opposite. Consumer debt exploded because once interest was no longer deductible, banks had no reason to keep rates reasonable. The cap was off. Total American credit card debt today, $1.277 trillion. That number did not exist in 1986. It was built quarter by quarter from one piece of legislation that nobody talks about anymore. Welcome to the Survival Research. Subscribe and hit the bell. The first link in the description opens the suppressed file the lending industry hates. Now back to what they buried. Here's what nobody told you. The Amish, for 300 years on this continent, have run a financial system that does not include any of this. No credit cards, no revolving debt, no 22-year payoffs. The average Amish family pays off their farm in 10 years, sometimes less. They live on cash. They borrow only for property. And when they often borrow inside the community at zero interest, backed by the church. Sociologists studying Amish finance use one phrase repeatedly. Bad debt is hardly a concept. That is not a slogan. That is an operating principle. The system works because of three things: cash discipline, mutual aid when crisis hits, and a hard floor on consumption. They do not buy what they cannot pay for in cash. Apply those three things to a household carrying average American debt, and the math changes completely. $20 a day, redirected, that is $600 a month, against $11,500 at 23%. Paid off in under 2 years, against $30,000 under 5. $20 a day is the price of 2 coffee shop visits, 1 delivery dinner, 1 streaming service, plus a subscription you forgot you had. The number is not extreme. The discipline is stop. Before I show you how this actually works step by step, here is what the lending industry does not want cataloged in one place. 1. The exact snowball sequence that pays off $5,000, $10,000, or $50,000 in debt with the same monthly amount, with the math worked out month by month. 2. The Amish cash envelope system, broken into the 7 categories that handle 90% of household spending. 3. The mutual aid framework. How small groups outside the Amish use the same principle to cover medical bills, repairs, and emergencies without insurance. It is all in the suppressed file, step by step. Numbers worked out for every common debt level. Scan the QR code on your screen or hit the first link in the description and get it now. Let me keep going. The snowball method works because of how interest compounds against you. Most people approach debt the wrong way. They split their extra payment across all balances. The math punishes that approach. The right move is the opposite. Pay minimums on every debt except the smallest, throw everything extra at the smallest one, kill it, then move that entire payment to the next smallest. The amount snowballs, so does the speed. Take an average household, $11,500 in credit card debt across 3 cards. Minimum payments come to about $300 a month. Add $20 a day to that, $600 extra. Total monthly attack, $900. Smallest balance gone in 3 months. That payment rolls into the next. Next, gone in 6 months. Last balance by month 20. 20 months, not 22 years. The interest you did not pay along the way. Calculate it. Roughly $16,000 saved versus minimum payments. $16,000 that would have gone to the bank, staying in your account. That is the math the lending industry was built to obscure, not hide. Obscure. Make it so you never sit down and run it, because if you run it, the entire model collapses. Still watching? You are already past where the lending industry assumes you will keep listening. Everything I just laid out, and the next part, which is the part they really do not want spreading, is in the file the banking industry hates, with every number worked out and every step laid out. Scan the QR code on your screen or hit the first link in the description and get it now. Let me keep going. Here's the part that connects everything. Why was the deduction killed in 1986? Officially, to discourage debt and encourage savings. That is what Treasury said. The actual outcome was the opposite. When interest is deductible, lenders compete on rate, because every dollar of interest is partially refunded by the IRS. The lower the rate, the more attractive the loan looks against the deduction. When the deduction disappears, the calculation flips. Now lenders do not compete on rate. They compete on credit limits, on rewards programs, on approval speed. The interest rate stops being the variable consumers shop on. It becomes invisible. That is how you get from average credit card rates of around 12% in the early 1980s to 23% today. The deduction was the brake. Removing it removed the brake. This is documented. This is congressional record. Nobody had to invent any conspiracy. They published the bill. The bill is the record. Now, layer on the second move, minimum payments. Most people do not know this. Banks used to set minimums high enough that balances declined meaningfully each month. After credit card deregulation, that floor effectively disappeared. Banks now set minimums at 1 to 2% of balance, at 23% interest. The balance grows almost forever. That 11,500 household debt at minimum payment, 22 years to clear, 18,500 in interest. The bank collects more from you in interest than the original debt itself. That is the model. The Amish saw this coming 300 years before it happened. Their refusal to use revolving credit is not religious. It is mathematical. They ran the numbers. They opted out. Now here is the practical application. Cash envelope system, 7 categories: groceries, gas, eating out, entertainment, clothes, personal, miscellaneous. At the start of the month, cash goes into 7 envelopes. When an envelope is empty, that category is done for the month. The reason this works is not budget logic. It is psychological. Pulling cash from an envelope hurts. Tapping a card does not. The pain is the brake. Reinstall the pain, kill the spending, free the money for debt payoff. Studies on payment method and spending consistently find that people paying with cash spend less on identical purchases compared to card payments. Same products, same stores, same people. The medium changes the behavior. Run the numbers on your last month. If you spent $4,000 on cards, the same purchases in cash often come to $3,000. That is $1,000 a month, not 20 a day, 33. Add the snowball to the cash envelope system, add the Amish principle of community lending, even informally between trusted friends, and the average household debt clears in under 2 years, not 5. 5 years is for people with 30,000 or more, 40,000, even 50. The $20 a day system applied with discipline eliminates that range in 5 years. Anyone below that, faster. The mutual aid piece is the part most people miss. The Amish do not carry commercial health insurance. They have what is called Amish aid. When a member faces a major medical bill, the community pools cash to cover it. The bill gets negotiated down because the hospital knows it is getting paid in cash. Immediately, no insurance bureaucracy. Hospitals routinely accept significantly less from cash patients than they bill insurance companies. Same treatment, different price. Because the only variable is who pays and how. This is not unique to the Amish. Anyone can negotiate medical bills if they pay cash. Most people do not know this is allowed. They submit insurance, accept the leftover bill, and pay full price for their portion. They never asked for the cash discount that exists for everyone. Same for major appliance purchases, same for furniture, same for some car repairs. A cash discount exists at many businesses that take credit cards, because credit card processing costs the merchant 2 to 3%. Pay cash, ask for the discount. Many will give it. A household running cash discipline saves real money on most purchases. Stack it onto debt payoff. The snowball gets faster. Now back to 1986. Reagan signed the bill in October. The change took effect in phases. By 1990, no consumer interest was deductible. The credit card industry had 4 years to adjust pricing. They did not lower rates. They raised credit limits. Total credit card debt in 1980, around $55 billion. By 2000, roughly $680 billion. By 2025, $1.277 trillion. That curve is the curve of one tax change compounding over 40 years. Every dollar on that curve is a dollar pulled out of household savings, retirement accounts, and home equity, transferred to bank balance sheets through interest, year after year, compounding the wrong direction. The Amish opted out 3 centuries before that curve started. Their financial outcomes today are documented in academic studies. Average Amish household debt is dramatically lower than the average American household and concentrated almost entirely in productive assets: land, tools, buildings. That gap is not religious. It is not about technology. It is not about lifestyle preferences. It is about one decision repeated daily for generations. Do not borrow for what you consume. Borrow only for what produces. A house produces shelter for decades. A farm produces food and income. A business produces revenue. Those are loans the Amish take. A vacation produces nothing. A new couch produces nothing. A dinner produces nothing past digestion. Those are not loans. Those are cash purchases, or they do not happen. The lending industry built the entire credit card model on convincing people otherwise, that borrowing for consumption was sophistication, modernity, convenience. The Amish call it what it is. A meter on your life, $20 a day, 5 years on the worst household debt loads, 2 years on average, cash envelope to free up the 20, snowball method to deploy it, mutual aid principle to handle emergencies without new debt. That is the system. There's nothing patentable in it, nothing copyrightable, nothing the lending industry can buy out, suppress, or modify directly, which is exactly why it disappeared from public consciousness after 1986. Not because anyone hid it, because the financial system stopped teaching it. Schools do not teach cash envelope systems. Banks do not teach the snowball method. Credit card companies do not explain the math of minimum payments. The information was always public. The visibility was not. Let me be clear about what this is and what it is not. This system works for revolving consumer debt, credit cards, personal loans, most household debt categories. It does not replace bankruptcy counsel for catastrophic debt situations. It does not replace a qualified financial advisor for complex investment decisions. For the average household sitting on credit card balances, auto loans, and consumer debt, the categories the 1986 Act made non-deductible, the $20 a day system clears it. The math is documented. Used by millions of households outside the Amish, mostly through programs like Dave Ramsey that teach the same principles without the cultural context. The Amish were doing it 300 years before Dave Ramsey wrote his first book. The 1986 Act made it harder for everyone else. The system still works. It just stopped being obvious. You already pay $20 a day to the lending industry, in interest, in subscription creep, in small daily purchases that compound to big monthly bills. The question is whether you keep paying it to them or redirect it to your own balance sheet. The bank is going to keep sending statements. The minimum payment is going to keep being engineered. The interest is going to keep compounding. Or you apply $20 a day, the snowball method, and cash discipline. The debt disappears. That is the choice. Comment below with your current debt total and the year you want it gone. Just the number and the year. Watch what happens when other people do the same. The community in the comments tracks this. Some get specific math worked out by other viewers. Some find accountability partners. Some just write the number for the first time. The Amish system is not religious. It is mathematical. It is older than the Federal Reserve, older than the income tax, older than the country itself. The 1986 Act did not literally bury anything. It removed the one thing that made consumer debt feel reasonable to carry, the deduction. Once that was gone, the lending industry rebuilt the entire personal finance landscape around extracting interest. And nobody told you. If this changed how you see your statements, subscribe. The next file is on what 1986 did to mortgage interest, and the loophole most homeowners miss every year. Scan the QR code on your screen or hit the first link in the description and get the suppressed file now. $20 a day, 5 years on the heaviest debt, 2 years on average. The information was always there. Now you have it.